The market just taught us something profound about human nature. While everyone was focused on the Fed's quarter-point cut, the real story was unfolding in the shadows, a rotation so swift it caught even seasoned investors off guard. The Nasdaq fell nearly 2% while the Dow hit all-time highs. Oracle dropped 11% on a revenue miss. Broadcom crashed 12% despite beating expectations, and cannabis stocks exploded 30% on policy speculation. This wasn't random market noise. This was human psychology creating exploitable patterns in real time. Here's what most people missed. Markets entered this week with dangerous consensus. Everyone knew the Fed would cut rates. Everyone believed AI infrastructure stocks were untouchable. Everyone assumed the momentum would continue indefinitely. But consensus is where opportunity dies and risk multiplies. When the crowd moves in unison, the system becomes unstable. And instability, for those who understand it, is where profits hide. Let me show you exactly how human behavior created three distinct opportunities this week, and why the disciplined approach to each one separates systematic wealth builders from reactive traders. The first pattern was relief-seeking behavior meeting reality. The Fed delivered the expected quarter-point cut, but Jerome Powell's message was clear. We are well positioned to wait. Translation: the easy money era is ending. The human response was predictable. Disappointment that the central bank wouldn't continue aggressive easing. The system response was immediate repricing of rate cut expectations for 2026. Bond yields climbed. Growth stocks with high multiples faced pressure. Financials rallied on steeper yield curve expectations. This is exploitable because humans consistently confuse what they want with what they'll receive. Goldman Sachs gained 5% for the week, while Nvidia fell over 3%. The crowd was positioned for dovish surprises. The disciplined investor recognized that 3 rate cuts in 4 months already represented accommodation, not the beginning of a cutting cycle. Second-level thinking means understanding that central banks respond to data, not investor preferences. The second pattern was narrative fatigue in AI infrastructure. Oracle reported 14% revenue growth but missed expectations. The stock fell 11%. Broadcom beat quarterly results and doubled AI chip guidance to $8.2 billion. Yet crashed 12% on margin concerns. AMD, Micron, and Nvidia all declined in sympathy. The human layer here was exhaustion with perfection pricing. When stocks trade at multiples that assume flawless execution, any deviation triggers selling. The system rewarded this behavior by creating a rotation into value names that had been ignored during the AI euphoria. Healthcare, industrials, and financials absorbed the capital-fleeing technology. This wasn't panic, it was recalibration. Participants finally asked whether AI capital expenditure cycles justify current valuations when monetization timelines remain uncertain. The Stoic approach is to recognize that even transformative technologies face valuation gravity. Price is what you pay, value is what you get. When the gap widens sufficiently, mean reversion becomes inevitable. The third pattern was speculative reflex activation. Cannabis stocks exploded on reports that Trump might ease marijuana restrictions. Tilray gained 33% in a single day. Canopy growth jumped 23%. This demonstrated how quickly capital mobilizes when regulatory catalysts emerge. The human behavior was FOMO, fear of missing asymmetric opportunities. The system behavior was momentum chasing in a forgotten sector that suddenly offered optionality. History shows humans consistently underestimate the speed of capital rotation when narratives shift. The disciplined response isn't to chase these moves after they've occurred, but to maintain exposure to potential regime changes before they materialize. Portfolio construction should include positions in asymmetric opportunities even when timing remains uncertain. The cannabis surge was available only to those who held positions before the catalyst appeared. Now here's where it gets interesting. These three patterns weren't isolated events. They were connected expressions of the same underlying dynamic. Late cycle market behavior, where participants seek downside protection without abandoning equity exposure entirely. The Dow outperforming both the S&P and Nasdaq quantified this preference for tangible earnings over speculative growth. The Russell 2000 hitting intraday highs before closing down 1.5% showed small cap enthusiasm colliding with risk-off sentiment. The technical picture confirms this interpretation. The S&P 500 fell less than 1% from all-time highs, hardly a collapse. The VIX rose modestly to 15.74, indicating increased hedging without signaling fear. This was distribution, not capitulation. Markets that consolidate after advances create foundations for subsequent moves. The absence of panic selling suggested participants view current levels as fair value requiring adjustment, not bubble territory requiring exit. The Stoic framework reveals the deeper lesson. Markets delivered instruction in the difference between prediction and preparation. Those who positioned for specific Fed outcomes received education in context dependency. Those who concentrated in AI momentum trades faced uncomfortable deleveraging. Those who maintained exposure across the valuation spectrum navigated the rotation without forced decisions. This connects to a fundamental truth about market exploitation. The system rewards process over prediction. Human beings are predictably irrational in their need for certainty, their tendency toward consensus, and their emotional responses to unexpected outcomes. But these behavioral patterns create recurring opportunities for those who maintain discipline around position sizing, sector diversification, and rebalancing protocols. The week reinforced that volatility is feature, not bug. Markets that move only in one direction create complacency and misallocate capital. The Friday sell-off after Thursday's record highs reminded participants that drawdowns are the cost of admission for equity returns. Those who structured portfolios to withstand normal volatility experienced discomfort, but not damage. Here's your systematic framework moving forward. First, recognize that consensus is where opportunity dies. When everyone expects the same outcome, position for alternatives. Second, understand that narrative fatigue creates rotation opportunities. When sectors become overextended, capital naturally migrates to undervalued alternatives. Third, maintain exposure to asymmetric catalysts even when timing remains uncertain. Regulatory changes, policy shifts, and technological disruptions emerge unpredictably, but reward those who stay prepared. The market's message this week was clear. The environment is shifting from momentum to selectivity, from growth at any price to growth at reasonable prices, from central bank accommodation to data dependency. Those who adapt their process to these new conditions will exploit the behavioral patterns of those who don't. The crowd reacts emotionally to each data point and policy shift. We remain disciplined, focused on the systematic opportunities that human nature continues to provide. Because in the end, markets are exploitable precisely because human beings are predictably irrational, and that's not changing anytime soon. What patterns are you seeing in your own portfolio allocation? Share your thoughts below, and let's continue building systematic approaches to market exploitation together.